everybody that's joining, my name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour, Dan Nathan, risk reversal himself. We're going to be talking about current market action, and I want to get a little bit deep on how to think about environments that we haven't really seen before in history. And I know that sounds dramatic, but I think part of the objective for me here is to try to get people to think differently as opposed to try to provide a solution. So, Dan, I know a lot of people obviously see you in the media. I don't know how many people know about your background pre-media. Talk about how you got involved in markets and what's your analytical skill set.
Yeah, no, I appreciate that, Michael. Thanks for having me, man. I've been enjoying your spaces. I started in 1997 at a hedge fund. It was a long-short hedge fund called SAC Capital. It's now called Point 72. I was there for a year and a quarter working with a guy. At the time, I know really jack about markets. I had worked in summer in a couple years, a couple summers for a stockbroker, and I was always interested in markets. I worked for 2 years for a bond brokerage firm in the summers also. And so I just really, I love the energy. I love the idea that it was a new game every day, if you will, And when I started in 1997, it was really interesting because these guys were kind of serious traders, and they were trading stocks, they were trading futures, they were trading options, they were trading indexes, and they were trading everything. And for me, it was like, oh my goodness, this is kind of like the Wild Wild West. And at the time, I remember somebody on that desk said, "You're the youngest guy on the desk. There's this group of stocks that are trading all over the place. None of us know what the hell they even do. Is YHOO, XCIT, LCOS, AMZN, stuff like that, right?" And so I started covering the internet sector, and we were really catalyst, momentum driven back then. But I also remember at one point in 1998. They trotted out a research analyst, and they paired him with a sector trader. And they said, listen, it's one thing to just kind of understand some of the things that you're keyed on every day that you think are moving stocks or whatever security. But now you really need to start understanding the fundamentals. And so for me, that was kind of a bit of a sea change. I started covering tech very closely. I worked with the guys I worked with there for many more years until the mid-aughts. And I traded a prop book at Merrill Lynch in 07, 08, and early 09, believe it or not, in their equity derivatives group. So I had a front row seat for the financial crisis there. And so really since 2009, when I left, I started my own business. I started doing a show on CNBC called Options Action. It was every Friday. And I did that for 10 years. I've been on CNBC's Fast Money since 2011. And I manage risk reversal advisors, where I advise private companies, investment banks, a whole host of financial sort of institutions on different things. I'll just leave it at that. And so I've been trading throughout for all those years. And, I kind of really, I think of myself as a bit of a strategist, and my, core competency is kind of understanding, I think, listen, Michael, you've heard this expression all the time. People ask you, what's your edge, right? What's your edge? And so sometimes, experience can play into that answer. I know a lot about tech and cycles and how that's reflected in markets, and understanding, certain frameworks that work well. And then, about, I don't know, I guess it was in the late 2000s, I kind of overlaid, derivative theory to the whole thing. So it's a bit of a mixed bag, but, I enjoy it, and I enjoy talking about it. Sounds like you've been talking about markets all day, and there's a lot to talk about right now.
I want to hone in on the word serious when you said, you worked with serious traders for a moment, because I think there's a really big distinction between a trader who is just following the crowd and the level of analysis that they do is really just a chart, versus those who really know how to manage risk. I want you to talk through to the audience what defines, in your view, what makes somebody a quote unquote serious trader.
Yeah, and I guess that's a pretty subjective sort of word, if you will. I mean, listen, I don't think that all of these individuals who've been buying meme stocks or altcoins or whatever are not serious. I mean, they're serious about trying to make money, right? Or they're serious about trying to kind of stick it to the man or whatever. You know what I mean? So when I mean serious is, I learned a lesson very early in my career in the hedge fund business that I remember sitting around one day, and it was a really brutal day for the pod that I worked with. And, I'd spent a lot of time, I played sports, I played lacrosse in college, and, the whole kind of, being able to kind of take a loss and being a good sport and kind of razzing the other guys and this and that or whatever. And I remember I made, I can't remember what the joke was. We had probably our worst trading day of the year. And I made some sort of joke. And this guy that I worked for looked at me with like these eyes that I'll never forget to this day and made one kind of comment to me about it. And I knew pretty quickly how serious it meant for him to lose money. You know what I'm saying? And so it was kind of like, it was definitely like a life or death situation. And, some people think that it's not that way managing other people's money. They're less serious about it, right? If you work at a big, I don't know, maybe it's a mutual fund complex. You don't care one day the market's down 3% and you underperformed your benchmark. Maybe we'll get it back then, But like when you're doing it on an absolute return basis, these guys were really, really serious about it. And obviously it leads to some weird incentives. But that's one word I feel very comfortable using to describe my time working with that group of people because they took it all very seriously.
Yeah, and especially obviously as you mentioned, it's when there's losses. The old prospect theory. People feel the loss of a dollar, twice as much as the joy of the gain
Correct.
of a dollar, right? Which goes back to the Great Depression, which I think everybody in markets is to some extent feeling. Now, you mentioned that you joined the prop desk '07 and you traded through '08, '09, and I put out a couple of tweets before this most recent decline saying that this is far more treacherous of an environment, in my opinion, than the 2020 COVID crash and far more treacherous than 2008. And even today, I put out a tweet saying this is worse than 2008. Now, like you, I was trading that period in 2008, and that was a period where not only did my family's firm close down, my father passed away, but then, of course, Lehman, and what the hell do I do with my career and my life? It was actually, looking back at it, was just a remarkably difficult period personally and professionally, right, in 2008. I want you to talk about how trading in 2008 compares to today. And the reason I'm asking that question is, to me, what makes this so nasty of an environment is that there legitimately is really nowhere to hide. Right? Yeah. You don't have that risk-off behavior in treasuries, although maybe that's starting to come back finally. You don't have any sort of clear sense of the Fed being able to do anything about this to help support markets. So let's do some parallels here. What makes this maybe similar or different than 2008?
Yeah, no, that's a great point. And your use of the word treacherous is a good one because it is. And I think that I would also say that it was really got here by complacency. You know what I mean? And there wasn't really a care in the world. And Michael, you and I talked about this probably on a couple of occasions over the last few months. Last year where the S&P closed up 26%. The NASDAQ closed up more, but under the hood, there was actually some really bad action and no shortage of different, sectors within the equity market, and dozens and dozens and dozens of stocks were telling you something was wrong, right? And so when I think about comparisons to past bubbles that kind of burst, here's one thing. The last time the Fed raised 50 basis points at a meeting was May of 2000, right? So they just did that last week. Well, what happened then? I mean, the Fed at the time was raising interest rates to kind of slow down an asset bubble, right? They didn't think they were hiking into a slowing economy, right? And I actually think that's very similar to what they did right now. By all indications, this is a rip-roaring economy. Look at where unemployment is. It's almost back to pre-pandemic levels. And we have this wage growth. And, the list goes on, right? About people have been saying why the economy is so strong. I've thought the exact opposite. Without the government transfers, with all the monetary stimulus, all the fiscal stimulus, this economy would have been in a wreck. And we were already starting to slow down, I think, into 2019. So again, the Fed was raising in 2006, and they were trying to slow down an asset bubble in housing, right? The economy was rip roaring. And what did they do? They ended up hiking right into a recession. And that was, a bit of a financial crisis. So then I'd say what's different this time is that they're not hiking to like slow down an asset bubble. They're hiking to slow down a bubble in prices of goods and services and in commodities and everything like that. And so to your point, they don't have the tools in their toolbox right now to worry about asset prices, right? When they're more worried about, basically stable pricing of goods and services and that sort of thing. So to me, that's what's really different. And I think that's the thing that just really the markets, or at least investors, have just started to realize over the last few weeks, because Go back to mid-March, right before the Fed raised 25 basis points. So that was the first, Fed funds increase, since 2018. And the market was careening lower into that, bottomed out right before it and ripped 10, 11%, I think, in the S&P off of that. Since then, in early April, it's just been lights out. I think the S&P was down close to 10% in April, and now we're down more. The S&P is down 17 and a half on the year. And so to me, I think that the Fed, there is no put that they can put in place. If they were to pivot dovish because S&P is down 25% from its highs next week, I think that's bearish. I think it doesn't actually give investors any solace in a way. It actually would confirm that now they're more worried about a slowing economy than they are about inflation. And I know that, Michael, you look at things like this, the inflation break evens 1 year out. I mean, it's starting to come down. Okay. So a lot of people might be right about that. Maybe inflation peaked despite this morning's CPI number that came in hotter than expected. But if they turn their sights on dealing with a weakening economy and focused on what might be the negative wealth effect from the stock market going down or housing going down or both, then we got some problems here, because the prices that are coming down, CPI from 8%, even if it comes down to 6% or 5%, that's still, really, really high, right? If you look at it over the last 40 years. So I think they're in a bit of a pickle, and I think that's what's going on with the markets right now.
Yeah, I was just looking as you were talking at the percentage of stocks in the NASDAQ composite that are trading above their 200-day moving averages, respectively. Yeah. And as of right now, right after the close, obviously, right now it stands at 9.9%. Yeah. So the vast majority of the NASDAQ not only peaked in February of last year, which already makes this a prolonged bear market, I would argue, but you've got real abject fear, to your point, devastation beneath the surface. Now, but let's play this out, and that's why I named the space the stock market Great Depression of 2022, not to be overly dramatic or for clickbait, but there's an interesting sort of thought experiment here, which is that the Fed's hiking rates in a market that has been decimated, which the headline averages really are not fully showing, at least maybe a little bit they are now, but not nowhere near like the average stock. When you consider that the real return after inflation of most stocks, factoring what we've seen for the last year, is so negative, is there any argument to be made that this is the contrarian setup, that despite all this talk about the Fed hiking rates, that markets are due for a bounce? Because I don't know, it's just remarkable to me that when you look at a lot of these speculative stocks, they just haven't had any give.
Listen, they're due for a bounce, and they're going to rip your face off if you press shorts. And that's one thing that I've learned, trading through multiple cycles like this, is that, when everything feels really bad and you're waking up at 4 a.m. hoping that the futures are lower, you know what I mean? Like that sort of thing. That's actually the exact wrong sort of inclination. The only other time you really got paid to do that was like August, September, October of 2008, right? Like, and I just kind of go back even to the prior crisis to that, the bear market, in 01, 02, and obviously 00, throw that in there, that was just one step forward, 2 steps back, and it just went on and on. And so, I think, I'm not hoping for a crash here. I think the word crash is one of those ones that's it's kind of misconstrued pretty often. I think a lot of people who lived through 87, that felt S&P lost 50% of its value. The NASDAQ lost over 80, and then in 2007, the market topped out in November. It didn't bottom until March of 09. So the one thing that I think that a lot of new investors to the markets over, let's say, even the last 10 years, is that they don't know what a protracted bear market feels like, because, in 2018, when the stock market went down 20% in like 2 months, that was the last time 10-year treasury yield was above 3%. We went down, bang, like that, right? And then what did the Fed do? They pivoted. Well, they can't pivot right now, right? So then the market ricocheted back. Then in 2020, right, they had rates at a certain level where they could lower Fed funds from 2.5 to 0, and they could certainly expand the balance sheet, which they did by trillions. But what did they do? They had a 35% peak to trough decline in what was clearly a black swan. No one saw that coming, and no one knew how bad it could get. Well, it did the job. Within 4 or 5 months, we're back to the prior highs. And then after that, it's just, breakout city, right? Like from there on out. And that was just a liquidity induced sort of thing. So the difference here that I think is that whatever the S&P, it's not going to bottom anytime soon, right? There's going to be fits and starts. You're going to have rallies like we had in late March, and maybe they start getting smaller. Maybe they're not 10% or something like that. And there's going to be no shortage of people who refuse to kind of let go of their 5,000 targets or whatever the hell they have for the S&P at year end. But we're going to go lower before we get higher for one main reason. And I tweeted this yesterday. It's like right now, S&P earnings estimates consensus is still calling for north of $220, up 10% year over year. That's just not happening. Look where the dollar is. Look where rates are. Look where crude oil is and other commodities, right? Look at, we just had peak margins. Look at some of the stuff that we're hearing both in the private markets and the public markets, right? About intentions on spending. We're going to start seeing job cuts all over the place. So to me, I feel like that we're likely to have a recession if not in the first half of this year, the back half of this year into 2023. Recession doesn't mean stock market crash. Recession doesn't mean, prolonged bear market, but it could mean all those things. And I think that's the biggest thing right now is that until strategists chop those numbers, I want to see 208 and I want to throw an 18 multiple on that. 17 is the 10-year average of the PE on the S&P 500. Throw 17 on 208. It gets you to 35.50. That's not great, but it's not horrible. 34.50 was the February 2020 high. And it would take out all of that excess, reset expectations, right? All of that negative sentiment probably gets washed out down there and sets the stage for another bull run.
I'm glad you mentioned that the term crash is thrown around a lot. And, I remember when I used to write for MarketWatch, I know for a fact that whenever I would put the word crash in a title, I'd get 5 times more views, right? There's a clickbait aspect to that word. But I want to spend a little time on defining what a crash is for a moment, because to your point, that term is thrown around a lot. To me, a crash is not about how much you go down, but rather how much time you give back, right? So I would argue that what's happened in the bond market is a crash, because in a matter of 2-3 months, you gave back many years worth of returns. How do you think about what the definition of a crash should be and how that changes perhaps by asset class? I think you're on mute, Dan.
Sorry, guys. I'm actually getting over my second bout of COVID. I was cleared today, but I'm still a bit groggy, like my voice and all that sort of stuff. So
you're a fucking champ, Dan.
I'm coughing. I'm coughing a lot when I go on mute and drinking a bunch of water. So great question. I think a crash can be termed like I think you could think of it in valuation terms. Look at what's going on in these SaaS stocks, right? Like no one gave a shit about any of these money-losing companies that were trading with huge market caps, 20, 30, 40 times sales. You know what I mean? Last year, no one cared. And, you could have thrown a dart out of any of these names that were over 20 times sales over the last few months. And those stocks are down 30, 40, 50%. And they're still going lower. Just look at the price action today in some of these names. And, people forget, like a stock like Adobe, this is a huge market cap company, was trading at, I don't know, like 15, 20 times, like some crazy number. This is, was a $200 billion market cap company. And so like there's a crash in valuation, right? So it trades about 10 times sales right now. It's much higher, right? We know how much it's down 30% on the year. You can do that math. Look at a Snowflake. I mean, this had last week over a $55 billion market cap. It was down 50%, and that was trading over 20 times sales. So you can have valuation crashes. You could have price performance that might not be, it just takes time to get to that low, right? And I think you and I are in agreement on that. I think that's probably what is likely to happen in 2022. There's no way the stock market in 2022 is up on the year again. I'd give you my left pinky on that one, or at least the tip of my left pinky on that. I don't see it happening. I think the likelihood of like a recession in Europe, the likelihood of, prices, like staying high for whatever reason due to supply chains, due to the war in Europe, this or whatever, that they're going to stick around here. And so I don't know. I mean, so I think time, I think valuation, and obviously price. But again, I have no idea where we bottom out. I look at the NASDAQ 100 down nearly 27%. That probably bottoms out somewhere, 40 or so. What's different, I don't know if you guys follow Gavin Baker, and he runs Treaties Management. And I think he's a brilliant tech investor who's at Fidelity for many years. He tweeted this out. He was on my podcast. I run a podcast also called On the Tape with Danny Moses and Guy Dami. They're my co-hosts. And Gavin was on with us a few months ago. And he mentioned he's always early. He's always early. But he tweeted out this morning, he's super bullish on mega cap tech here. Great inflation hedges, broadly growing revenue, gross profit over 10% with high ROICs, generally trading at all-time low EV to free cash flow and PE multiples, and almost all aggressively buying back stock. All time is a long time. This isn't '08 or 2000. Interesting. So he said mega cap tech now generally trades at a discount to high quality industrials, despite having more pricing power, faster growth, and higher ROICs. Okay. All of that I agree. All of that I agree. It's a matter of timing, right? That will be true down another 10% in the NASDAQ and the S&P. And it's true right now, but it's a matter of entry, right? Or how you kind of work into positioning. So just keep an eye on guys like him. He's smart. He's traded through, 2000. He's traded through the financial crisis, and he knows his stuff, and he knows it far better than me. But I think, to define crash, I do think it means that valuations have to overshoot to the downside the way they overshot the upside. Price has to do that. And then also, it probably is going to take longer than you think it will.
That last point actually is really important. It always takes longer than you think it will, and always tends to go deeper than you think it will. And in listening to you, it's interesting to me when you talk about it's unlikely that the market closes positive for the year. It's funny how these cycles repeat, because as I'm pretty sure that the second year of a presidential cycle is also the weakest, right? So that also kind of jives, I think, a little bit with anyway where we are in the environment.
Let me tell you this. I'll just hit that question. So last year I bought a Mustang Mach-E, a fully electric thing, and I thought it was a really cool car. And I put a deposit down on it. And I'm not a fan of Teslas, to be very frank. And I took delivery of it, and then I wanted to use it. I live in New York City. There's really no place to charge them in New York City. My parents live in Syracuse, New York, about 220 miles away. I supposedly had a 300-mile range on it. So here's the deal. EVgo, fail. ChargePoint, fail. The infrastructure is horrible. So the killer app for Tesla right now, and my buddy Danny Moses is on here. He's not a Tesla fan. He's listening. He's going to roll his eyes at me. The killer app right now for Tesla is that infrastructure that's built out, the supercharger stations, everything like that. So I was just going to tell you that, like, those companies, I don't know the valuations. I don't know where they're trading. I don't know anything about them, but they got a long way to go to make it so that all of these competitors to Tesla are going to be able to have people using those cars. As it relates to how far I think we could go, again, I just did a couple quick bits of math here. Right now, earnings estimates for the S&P 500 expected to be up 10% right now. That is consensus, about $220 or a little more. Let's be a little bit more conservative. Let's say it's 208, okay? Let's say it's up 5% year over year, which seems to me, again, that seems aggressive to me, given the landscape and everything you just laid out. Throw the average multiple of 17 times that 208, okay? And you get basically 3,500-ish. 3,500 is the level in which the market broke out from when we got the vaccine news in November of 2000, after the election also. And the prior high before the pandemic, the S&P was 3,550. So if the multiple on the S&P overshot to the upside and was trading at like 22 times, and the average is 17 over the last 10 years, might it go below the average? You know what I mean? And really, obviously, the moving target there is S&P earnings. But strategists and analysts have not actually budged yet. So to me, I think there's risks down to that 3550 level. And you mentioned small caps here. The Russell 2000, I don't know if you guys have checked this out anytime recently, but that's round trip the whole move back to its pre-pandemic highs. And if you think
isn't that amazing, by the way? Because that was all the stimulus was supposed to help domestic companies, which small caps are more sensitive to the domestic economy.
100%. And my buddy Guy Adami, he's been saying that. I remember one night on Fast Money, and this was, I think, in late last year, after it had that breakout. It was in that long consolidation, and then it broke down, or it came back into that consolidation range. The guy said he thought it was the most important chart in the market. He said he thought that large caps were going to follow suit, and he was really right. And when you think about inflation where it is, when you think about the potential for slower growth, you think about higher wages, you think about, the list goes on and on, supply chain disruption, all this sort of stuff. You say to yourself, okay, that's not a great setup, right? For those companies, the cost of capital is much higher, all this sort of stuff. So to me, I think the S&P has more to run. Could it bounce, in and around this 4,000 level? I don't think we get back to 4,500, which it did, on that last bounce that we saw, at the start of April. But I think it's one step forward, two or three back. And I think we just need that kind of estimate capitulation. And we probably need a Microsoft or an Apple to kind of pre-announce negatively, to just say that there's some things that are pretty effed up here and their guidance needs to be rejiggered mid-quarter. And let me just tell you this, as we get through May, you're in the last month of the quarter. And Michael, this, there was Semiconductor companies used to hold mid-quarter updates. They used to do it the first week of the last month of a quarter. You know what I mean? That's always a good time to keep a heads up, where if their projections, are not being realized in a material way, you could see pre-announcements, but definitely in the mid to the back half of June. And maybe that's the thing that helps it get that way and kind of gets analysts kind of throw in the towel a little bit and lower their estimates.
By the way, it's important to note that I know everyone always wants to talk about how bad things can get, but I always go back to this point that path matters more than prediction, right? It's not about the endpoint, it's about the dance in between the endpoints, because you could ultimately be a lot lower in equities, a lot higher in yields a year from now, but you might have some of these, to your point, rip your face off rallies in both asset classes before ultimately making lower lows. And ultimately, that's where people get into the most trouble, right? From a trading and investing perspective. Just want to put a little context on that. I brought up your friend Danny Moses, who's always apparently looking for the next big short based on his profile. But Danny, welcome. I don't know if you want to add some thoughts here.
I think it's key to, I don't think stocks ever should have been where they were. Meaning, I don't think S&P should have been up, 47, 40 to 100. So when you think about how much it's down, don't think about that it's down, 17.5% or 18%. Think about what the level is naturally that you'll have some type of equilibrium, right? And I think all the stimulus stuff that we saw in the Fed, I just think we're dealing now with something we haven't had to deal with in 13 or 14 years, and that's with the Fed not having your back. So when you think about the stuff that we never had to deal with after 2008 and 2009 because of all the liquidity in the programs and QE 1, 2, 3, and then 4 because of COVID, we're now going to have to deal with that. So, you're seeing now finally, I think you're getting, not, I wouldn't say later innings, but mid innings of things like, I always tell Dan, and he's right, these aren't big companies, but to me, they're indicative when you see the KMCs of the world and the Bed Bath & Beyond start to finally just kind of grind lower without, even when the market rallies, these things don't rally with them anymore. That's a sign that we're getting closer and closer, I think, to a level. But that being said, Dan always points out the generals of the market, the Microsofts, the Googles, they are certainly expensive relative to the market. And are they good companies? Yes. But if those sell off 20% from here, I mean, we are dealing with where do you kind of hide? And I'm actually watching the 10-year yields right now and from afar. So I've never really been in tune this week with the markets as much, but just watching from afar, I think you'd rather see 10-year yields moving a little bit higher, meaning you want there to believe that there's growth coming. And I think we're dealing with stagflation. I think we're staring stagflation in the face. And I'll just end with, I think we're looking at 3,000 to 3,200 on the S&P is where I think we'll kind of find a bottom in a range. That being said, I think you can start to make your list of things that you want to potentially buy. But there's still a lot of froth out there. We got to work through it. So.
Well, one of the things I wanted to mention, Danny's been all over, we've been talking about it, I think since last summer, some of these business models, he's kind of, buy now, pay later. And he's been all over this Carvana story since it was, above $300. I will just tell you this, the disaster du jour, we've had over the last few weeks where every day there's like some household name, whether it be a brand or something like that, the stock's down 20, 30% or something like that. Some have been even more. That is something that's really indicative of like 01, 02, if we're kind of trying to compare the bear markets, if you will. I mean, it really seemed like that was like the get me out sort of situation, right? But one of the things I thought was really interesting today is that Coinbase, after its results, was down 26%. Unity Software was down 37%. So those were the disaster du jours. Those were the ones that like shit the bed on their earnings and that was it, lights out. But some of the prior disasters, Upstart, which was down last week one day, wasn't it down like 50, or the other day it was down like 50 or 60%? Was down 16% today. Affirm was it a few weeks ago, down 20% today. Carvana, Danny's Carvana, that thing was down 18% today. So
go back to the point. This is different than 2008. It's when you have things like that happening with mega companies at like just boom 3-4 days. Yeah. I mean, that's serious.
I was going to say, sorry, this is to make people not be as fearful. It is more and more like 2001, 2002 to Dan's point. These are not quality companies, but there is no buy point for these companies when they start to unravel because there's no earnings. What is the buy point for these companies when you re-underwrite and when the momentum leaves, right? These are retail held, they had momentum. They were growth stories that were really hiding as growth stories, I should say. And now what is a natural buy? And those just need to go by the wayside. That it is what it is. Those aren't the ones you want to buy. You want to wait for the Microsofts and the Googles to dip. 20%, right, Dan? And then you want to buy those.
Well, you know what I keep saying? Q's and twos, Q's and twos. I think that, the QQQ, you get all the ARC shit right in there. To be frank, that's down 70, 80%. There's dozens of those crap. And then, and listen, a bunch of those stocks, they're going to be up 100, 200% off their lows, wherever they bottom out, right? But then you're going to get those 5 or 6 names that make up nearly 50% of the weight of the QQQ. Now, to your point, Danny, you got to see Apple down 25% from its highs. You know what I mean? Where is that? Is it 125 or something like that? You got to see Microsoft, which is down 20% right now. Maybe it's 240. Google, great company, cheap valuation, a lot of cash. Maybe that, can't even tell. These companies have to split. I'm sick of looking at like 2270 or something like that. Amazon, 2100. Well, maybe it's 1900. So until we have that sort of capitulation on those major names, and you see the QQQ or the NASDAQ 100 down, you know what I mean? Somewhere in that, I don't know, what's the level? Is it 10,500 or something like that? Then you're going to have some very unusual values in some great companies, especially if you're looking more than a year out. Listen, I'll let Dan. I don't know if you guys know Danny. Danny was one of the guys featured in The Big Short, the Michael Lewis book, and the Adam McKay movie. He was on Eisman's team, and it's obviously a great book. And I'll let him speak about real estate in a way. Anecdotally, I just don't know how that asset can stay where it is after the appreciation that he had, after the weirdo migrations that we had, during this pandemic. And then when you see 30-year mortgage rates double, right? Really, they've doubled off of the recent lows. That's coming to a theater near you. Now, the Danny, you would probably argue there's not the same sort of leverage, but look at what's going on in the housing stocks, the home builders. Lennar and Toll were each down about 5% today, making new 52-week lows. That just seems like an accident waiting to happen. And I'll just say this: if you're trying to figure out what does a recession look like here, is it a consumer-led recession, or is it? The negative wealth effect from housing going lower and people pumping tons of money that they thought they were making in crypto and in the stock market back into their homes over the last, couple years, and now having stocks poof, having crypto go poof. It seems like a really bad sort of environment. And sometimes that word recession just being out there is the thing that causes consumers to pull back.
Yeah, I would separate residential real estate and commercial real estate. And maybe that's what you were asking. I think the commercial real estate market is, based upon cap rates and leverage. And I think as rates move higher, just from a relative valuation perspective, those are worth less. So I'm a little bit nervous on the commercial market. And if you track commercial mortgage-backed securities and the spreads there, and I think they're both impacted, let me just say, RMBS and CMBS the Fed was buying mortgage-backed securities, for the last 13 years, basically. And they're now, they're not selling them outright, but they're letting these things roll off. And that's having an impact. That's why mortgage rates are out much wider than treasuries, right? That's what's happening. And Wall Street will not stop front running that for a while, knowing that the Fed's not participating. So it has an impact on both. That being said, the home builders, I've been saying this for months, are the most rational sector in the market. They actually were the ones you can't meme stock the home builders, right? They are what they are. They have a balance sheet. They buy supplies. They deal with mortgage rates, and it has been telling you. So I would be watching the builders now. At some point, those stocks are going to be a buy, right? We're going to filter through these rate hikes. They're going to stop at some point, or they'll blink a little bit, and that will be the hottest sector, in my opinion. That's going to be the one that you're going to want to buy. And Dan knows me well. It's hard for me to talk about any sector that I want to buy, but those companies aren't in danger of going bankrupt. They're not over levered. They're cyclical plays. And I'd certainly watch and pay attention to their conference calls, listen to what the CEOs are telling you, or better yet, read the 10Qs and the 10Ks on what they're telling you. But there's a lot of different, and I'll end with this: that the housing market has been very secular, less cyclical in the last couple of years since COVID, right? People change their behavior. They move to states that have less taxes. They're working from home. I think this 3-day week, 4-day week is kind of, going to be here for a little while. So those have changed a little bit. And I think where you're going to see the market impacted is in the homes that are from 250,000 to 650,000. Really the market where people are dependent on mortgages to get done. Those are already getting hit hard. And that's why you're seeing the builders, since the publicly traded builders, that's where you'll get hit. So again, fluid. But I would, certainly something to pay attention to, but I would definitely separate residential from commercial.
Let me add a quick thought to that, because if you notice, those are not laser eyes on my Twitter profile. Those are lumber and gold eyes. And that relates to a paper that I put out in 2015. But the core thesis there is that every single major recession or major dislocation tends to be preceded by weakness in lumber. Now, on the one hand, you'd say to yourself, well, why the hell would lumber tell you anything about risk? And it's because of the link to housing, right? Because the average home has about 16,000 board feet of lumber. So if you want to really get a sense of real-time housing starts expectations, the best thing to do is to track the pricing movement of lumber. Now, what's interesting, Danny, in your discussion around home builders, is that lumber is confirming that, right? Home builders have been weak. Lumber is breaking down. Who knows how long that will last? But I've made this point that any kind of secondary big wave lower has to come from a deceleration in the housing market. It has to come from that as a disinflationary force. And I still think that's very, very early. Dan, I don't know if you want to add some thoughts to that, but just wanted to add some color to that discussion too.
Yeah, I mean, again, I think that the scramble for housing and it's just been, it was something very abnormal, to me. We spent the prior 10 years, I think, post financial crisis, seeing these huge migrations into cities where people believe there's network effects, whether it be Silicon Valley, whether it be Hollywood, whether it be Wall Street, whether it be, the energy business in Texas, or whether it be crypto in Miami. I actually feel very strongly about those kind of notions. I don't think you can decentralize, kind of network effects within industries like that. I know that a lot of people are trying to do that in a way. So I don't know. I feel like, again, I don't know how we can see the stock market if it were to kind of go lower and stay lower. I don't know, based on what we think is going to happen with the economy, that we're not going to see unemployment higher. We're not going to see, like everyone talks about sticky wages. And Danny and I have been talking about this on our podcast and on the tape for a while. Prior to the pandemic, we were really worried about, like how low wages could go. We were talking about things like universal basic income, because automation and all those low end jobs going away. A lot of the wage gains have been on the lower end, So you tell me, it's such a hot market for software engineers. Well, what happens? We've seen this in 01 and 02. What happens when all those startups go bust, man? They stop buying servers. They stop buying lunch and breakfast for their software engineers. They stop, they cut their budgets on AWS. They stop their ad spend. We had a call today without naming any names, of a service provider. And I had the CEO of a company say to me, hey, I've never had to deal with a market like this. And given his business, he's really worried about an event that he's got a lot of capital committed to and this and that, whatever. So we're getting into a period where lots of people are going to see things that they've not seen before, or they haven't had to model or solve to. And that's the thing where, again, Danny said this before, he never thought stocks should be where they were last year. Well, if you didn't think they should be there last year, when it goes the other way, you know what I mean? Like, you're going to see stuff that you didn't think could go that low. And I think that's playing out in parts of the market. So we can throw out buy levels for some great quality companies with great cash flow and, great balance sheets and big moats and monopolies and all that sort of stuff. But they're likely to go lower than you think, whatever you think that number is. And Michael, you know this as well as anybody. And Danny and I and Guy and I talk about this all the time. You'd say, yeah, I want to buy Disney at $100. Well, maybe if it like cuts through there like butter, you know what I mean? You're less likely to do it. So what's the new level? So, again, I feel like that's the one lesson I've learned, even in the financial crisis. And I know what Danny's point is that was a bit more isolated, at least the devastation to, a couple different sectors. It gave you more confidence to wade in to some of these other secular, non-financial related or non-housing related names. But right now, it just seems like there's a target on anything with, a valuation. I mean, even look at JP Morgan. Look at the premium that it had to many of its peers on a price to tangible book. It's going away. You didn't think that was going to happen, but the bank stocks started acting like dick well before a lot of other things started acting market this year, right? So I don't know. I just think that I don't think there's too many places to hide. I know people are going to say energy, materials, but let me tell you this: if we go into a global recession, good luck with energy and materials, especially given all the outperformance that we've had so far this year.
By the way, I don't recall ever hearing you on CNBC saying acting like dick, but I'm glad.
Oh man, I want to. I want to so sure often.
I've been a bad influence on Dan. So
yeah, you have.
Well, by the way, Danny, make sure you follow me because I want to DM you to get you also to be a spotlight guest for these spaces that I do. And for those, by the way, speaking about cursing, it's funny. I curse a lot on Twitter, largely because I just think it's funny to do. And there's a lot of studies that show that people seem to think you are smarter and more authoritative if you curse. So fuck it. I'm going to keep cursing on these spaces, just like Dan and Danny.
Adam, it's a great question. First of all, also thank you for listening to On the Tape. We appreciate that. Listen, I mean, here's one that I think headed into this kind of like malaise that we've had in 2022. A lot of people would tell you that they, thought this was a very defensible valuation, and I would just say this is that here's a company this year that's expected, to grow earnings and sales, 5% and 17% on the sales. So costs have gone up, you know what I mean? And trading at 20 times, trading 17 times next year for, mid-teens revenue growth and maybe a pickup in earnings growth, to about the teens. So on the out year, it looks really relatively cheap, all that cash. These announcements, I don't really love hearing about Google and Glass. You remember the last time they tried to do that, but maybe this time it'll be a bit more useful. It's kind of, today the stock acted pretty well for most of the day on a relative basis. I think there were some investors who liked what they had to hear from there. I mean, the one thing that's really funny is that this whole ARC thing, innovation, it seems like the only thing that she can say when she's being questioned about her strategy. And I think it's pretty clear that some of the most innovative companies in America are also the largest ones, right? And so the stuff that's happening under the hood, and at Google, at Microsoft, at Apple. And so I don't really buy paying those crazy multiples for some of those other names that are growing really fast, but they're not ever going to be meaningfully profitable. That being said, could Google probably goes to 2000. I mean, look at that consolidation in kind of early 2021. And then you have a multiple that needs to overshoot. You know what I mean? Like, to me. So I don't know. And then the other thing I'll just say about these Fortress cloud businesses, there was a company called Exodus Communications. Danny, you remember that one? This was basically a server farm company. Right now, we'd call it a cloud storage company, but they were basically, they're selling their services to every startup out there and every, major tech company that was looking to expand into the internet and all that sort of stuff. Well, it went bust in 2001. I mean, literally went bust. So to me, I think deceleration of those businesses in a more competitive environment where there are going to be lower margins, and that we know, at least for Amazon, that's like the crux of their margin, not a good setup. So like, I like to think about what can go wrong. We already know what can go right with those names, you know what I mean? But I would think that in the next couple months, we are going to see like some sort of like deceleration in those names and some of those fortress businesses that are going to make them go to the levels that you didn't think they could in the near term. And I don't mean to sound so dire. I think all of them make sense on a longer term basis if you look past whatever we're in right now.
I will say, only because you mentioned Kathy Wood, and I keep going back to this point that there are no gurus, only cycles. Right? And I think what we've seen in not only the terminology around innovation, but also in the religious fervor that happened around innovation, around Kathy Wood, around some of these cryptocurrencies, all this is a good reminder that everything is ultimately a cycle. It's just a matter of who has the loudest voice in claiming credit for it. Well, just more of a side note. But hold on, but let me turn that into a question, because I think it's an interesting thing to think through. Because if you are going to argue that that's likely or possible, and I don't necessarily disagree with that, Dan and Danny, my view on that is that given how much leverage there is in the system, that's the equivalent of a Great Reset, right? In other words, that's the equivalent of not only a Great Depression, but a system that's completely malfunctioning, because you're talking about collateral collapsing to a level relative to debt loads that makes our portfolios totally meaningless. So even if you're ultra bearish, how do you think about that end of the world type of setup, and what do you do with that if you really do believe it?
Dan, you want to take this one?
Yeah, this is in your wheelhouse.
Well, there's been, for the last 13 years, like the one thing that is different is we've never had a situation where Federal Reserve was buying assets like this. That's never really happened, right? You think about $9 trillion balance sheet, et cetera. So there's been no price discovery in fixed income. There's been really no price discovery in equities now for several years. And bottom-up fundamentals haven't really mattered. And that's now starting to matter. And that's why you're seeing, I call them orphan stocks. They're happening by the day. The Pelotons of the world, the AMCs, the GameStops, the Upstarts, the Carvanas. These are now orphans. And when I say that, what I mean is there's no sponsorship left. There's no banking revenue to be done. Therefore, analysts will downgrade them because we know what they do, and they'll just be left. And those are not the ones that you want to be buying. And you realize that cheap credit has been the catalyst for everything. It's been the catalyst for companies to leverage up their balance sheets, whether it's buying back stock or making acquisitions, whatever they want to do. It's been the catalyst for buying equities. I mean, it was 2 years ago, the Fed was buying HYG and J&K. The Fed were buying, airlines, or the Treasury's buying airlines. Like, these things were happening again. So I think more than anything, it's trying to figure out, re-underwriting the market and trying to figure out what is the intrinsic value of these companies and what is the relative discount rate that you should be using for risk. And we've just changed that dramatically, not because rates are up, but because the Federal Reserve doesn't have your back anymore. And I think this generation of investors, and I talk about it all the time, the average Robinhood investor is 32 years old. I was talking about it when they were 31, but I'm just going to assume they're 32 at this point because they're losing the younger ones and maybe there's the older ones. But it's been another year, and that means that a 32-year-old only knew from the age of 20 or 21 the Fed having their back, and that's what we're dealing with right now. And so I don't know how to answer that question. I don't believe we're going to have a down 66%. And the reason I say that is because inflation, right, rising tide kind of lifts all ship. You're going to need to put your money somewhere that is going to grow in value. And inflation can be good. for certain stocks, the market overall. And so I think we're just going to have to adapt to the new, which is the Fed doesn't have your back. So ending it with this, I look at companies, I look at their balance sheets. Are they going to need to raise, are they going to have debt that comes up for refinancing? Is their model predicated on, not earning money, but just revenue growth? Those are the things, and you need to look at that and decide. And I think instead of trying to find a bottom on kind of a meme stock for a quick trade, buy quality on the way down and find those buy points that Dan was just alluding to. And whether that's dollar cost averaging starting and beginning, I'm not sure, but we're in a new paradigm now, and I think people need to adapt to that. And so I'm old enough. I mean, I'm 52 years old. I came into the business in 1991, so I've seen a lot of this stuff. And again, I'll say this reminds me the most of 2000, 2001, not 2008. And it does remind me of 2008 because the banks are safe. The big banks are not over levered. We're not going to have a situation anymore with some undiscovered acronym. We'll have blowups, we'll have commodities, we'll have all this stuff happening, but it's not systemic. And so that, to me, will give us opportunity to potentially buy certain securities. So,
by the way, on that cheap credit, I just shared in the space a tweet I put out January 5th in all caps, breaking Bitcoin, stocks, bonds, commodities. It's all one big fucking leveraged trade. And that's really what we've seen, I think, with these tails that have been wagging. And I will say real quick on that, it's interesting, right? Because everyone, I think, is assuming energy is it. I'm pretty sure 10 years ago, 15 years ago, 20 years ago, everybody thought that the cycle leader around this time would be healthcare because of the aging population demographics. But Dan Nathan and Danny Moses, go ahead and
yeah, real quickly. I mean, for me, I'm going to keep this really simple, and I like to keep things really simple also because I have a lot of potential, like I like to be transparent in what I do. So, I try to do less than more. And I've been saying this in our podcast, Qs and twos. I mean, really, I don't think rates are going meaningfully higher. So I think you can buy treasuries at some point in the not so distant future. And then Qs, I just kind of feel like keep it simple, man. Like, again, going back to those top 5-6 names, I'm not really interested in Tesla. I think Tesla has much more to drop. But if you think about even a company like Facebook, which I don't particularly like, that is the cheapest of all of them. It's been cut in half or more so. It went from $1 trillion to less than $1 trillion. And then you look at all those other names, if they were to correct, I mean, I think you just kind of you dollar cost average into the Qs and then maybe buy yourself some TLT. And, that's how you kind of play a really difficult market. The other thing is, Danny, you're going to get so mad. I didn't buy any stocks today, but I did buy Ethereum. I did buy some Ethereum at 2100. So I know you're going to be like just disgusting. But
yeah.
No, Luna? What do you mean? No, you didn't buy.
No, but one thing I would just say this, I really do think, and I know Guy has been saying this on our podcast too, and he's not some crypto maven by any means, and Danny has actually been keeping a really close eye on a lot of these stable coins or unstable coins. When the Fed pivots, and they will pivot at some point, maybe it's late this year, that's when maybe crypto has, that huge run. It might be from lower levels in here. If you look at that Bitcoin chart, it looks like a bit of a disaster below 30,000. There's an air pocket down to 20, which is the high in 17, in the breakout in late 2020. I have another podcast called OK Computer. Meltem Demirors, that you guys, a lot of you probably follow her from CoinShares. She threw some stat out on her pod that's out today that 80% peak to trough declines are not they're not unheard of when it comes to Bitcoin. So that would be 14,000. I'm not predicting that. I don't have a position in Bitcoin. I don't really have a strong view in it. I just like the stuff that's being built on top of Ethereum, and that's why I add to it on weakness like this.
That's a move, by the way, that makes it sound like it's a store of value, which anybody that follows me gets that joke. But sorry, Danny, go ahead.
I was going to say, I mean, let's go through the Bitcoin argument that it was going to be a great inflation hedge and a store of value that hasn't proved out. I'll leave that to crypto people, but I would tell you that if you're waiting on the Fed to blink and you're in stocks waiting for that to happen, I think I would probably get out and buy at a lower point. But I mean, Dan and I have been going back and forth on gold for some time, but if you think that there's a situation where the Fed starts to blink, I don't think you can own enough gold. And what I think is going to happen is I think a lot of the Bitcoin, listen, at the end of the day, when it peaked, Dan, it was a $3 or $4 trillion market, total crypto, somewhere in that level, maybe just over 3 trillion.
No, it was much less. It was like 2.5.
No, with all the shit coins, whatever. Okay, so 2.5 or 3, whatever.
Yeah.
But in gold was a $10 trillion market. It's hanging around 11 or whatever. It stole its thunder because it was supposed to work in this way with inflation and so forth. But if you get to a situation where the Fed blinks, I would say that gold would be one of the greatest instruments that you could buy in some form. And when I say some form, you do not want to own GLD. You want to own the physical, which you can buy through PHYS, which full disclosure, Dan will that I do own, and I've been talking about it for some time because they actually own the physical. So gold would be the way that I would play that, but I don't think we're near that point yet. I think we're 30% in the S&P away from the Fed blinking.
So I think Danny Moses will save that for a space that you and I will do. But listen, everybody that's joined here, again, please make sure you follow Dan Nathan, follow Danny Moses. Guys, I really do appreciate it. And Dan, you're the fucking man. I mean, you're not you're not 100% health wise, and obviously you're on the mend, but I appreciate that you're doing this again. And everybody enjoy the rest of your night.